Welcome to the Solo Investor. Today we are going to talk about interest rates. If money is the lifeblood of the economy, interest rates are the pulse that sets its rhythm. And when that pulse speeds up or slows down, everything else, jobs, stocks, housing, even your groceries, follows. You can't see them, touch them, or hear them. But interest rates quietly shape almost every part of your financial life. They influence whether companies expand or lay off workers. They decide how much your mortgage costs. They even affect how much your savings earn while you sleep. The price of money. At its core, an interest rate is simple. It's the price of borrowing money. When you borrow $10,000 for a car at 6%, you're not just paying for the car. You're paying for the time someone else's money is in your hands. When interest rates are low, borrowing is cheap. Businesses expand. Consumers spend. Investors chase higher returns in stocks. But when rates rise, borrowing slows. Loans get expensive. People hesitate to spend. It's like the Federal Reserve adjusting the thermostat. Lower rates heat things up. Higher rates cool things down. Now, before we continue, let's touch up on the Federal Reserve, the economy's conductor. Think of the Federal Reserve as the conductor of a massive orchestra or choir. Each instrument, businesses, banks, consumers, plays its part. The Fed's job is to keep the rhythm balanced. When the economy slows, the Fed cuts rates to encourage growth. When inflation surges, it raises rates to keep spending in check. Even a small change, like 0.25%, when it can echo through the global economy. Stocks react instantly. Currencies shift. Mortgage and credit card rates follow within days. Interest rates aren't just numbers, they're signals. They reveal how the Fed sees the future, and everyone else adjusts their tempo accordingly. When the government moves rates, it creates a chain reaction. The effects ripple everywhere. First, banks raise the cost of borrowing. Car loans, mortgages, credit cards all climb higher. Next, the housing market cools. Higher mortgage rates mean fewer buyers and slower price growth. Then, the stock market adjusts. Rising rates make bonds more attractive, so investors move money out of riskier stocks. Businesses feel it too. Higher financing costs slows expansion and hiring, and eventually, consumers pull back. Credit gets pricier, budgets tighten, and inflation cools. It's a chain reaction, a balancing act between growth and stability. Raise rates too fast and you risk recession. Too slow and inflation eats your savings. But how does all this affect your wallet? Interest rates shape not just the economy, but your daily financial life. When rates rise, savings accounts start paying more. Mortgages get pricier, slowing home buying. Credit card debt becomes expensive. Stocks dip as borrowing costs climb. When rates fall, borrowing gets cheaper. Real estate booms. Growth stocks surge as investors chase returns. The game of interest impacts the cost of borrowing and the return on your savings. Even a 1% move can shift your payments, savings, and portfolio in a single year. So yes, interest rates affect Wall Street, but they also quietly rewrite the math in your own home budget. Interest rates and inflation are dance partners. When inflation rises, the value of your money falls. To fight that, the Fed raises rates, making borrowing harder and saving more rewarding. But there's always a trade-off. Higher rates tame inflation, but they also slow growth. It's never a perfect equation, it's a constant balancing act between stability and opportunity. For investors, the opportunities exist on both sides of the aisle. Focus on strong, cash-rich companies or bonds when rates climb. When they drop, recenter to growth and real estate, which have been known to recover. Smart investors don't try to predict every move. They build portfolios that adapt. because the economy changes faster than forecasts, but discipline always wins over prediction. You can't control the Fed, but you can control your habits. Pay down high-interest debt before it compounds. Build an emergency fund that benefits from higher yields. Invest consistently, no matter the rate cycle. Interest rates rise and fall like tides. The goal isn't to fight them, it's to sail with them. Because in the long run, it's not the Fed that determines your wealth. It's your behavior when the tides change. Interest rates may seem invisible, but they shape every decision we make with money. The more you understand how they move, the better you can move with them. Because wealth isn't built by guessing the next rate hike. It's built by understanding the rhythm of money. If you enjoyed the video, please like and subscribe. Thanks for watching The Solo Investor. And remember, knowledge is the best form of compound interest.